So as I said that on a 1-year basis, the absolute return of India opportunity portfolio has been 38.1%. In 31st March 2020, this was negative 35%. This is where all the pain came. 1-year negative return of 35% led to 2-year negative return of 23%, 3-year negative return of 15%, and literally took away all the returns of the 10 years. One sharp correction. But one sharp recovery of 38% has led to 2-year return of 23%, 3-year return of 12%. And as this builds up, the 1-year, 2-year return, you will see that the 3-year, 5-year, 7-year, 10-year, all will start to look much better. The process has started. The recovery has started. The initial signs of recovery is visible through the returns, and our investment expertise and your patience will certainly help for us to witness a complete recovery and a very good outperformance and very good outcome in the near future. But if you see the 3-year rolling returns, and this fund has a good track record from 2010, so almost 11-year-old portfolio. Broadly, on any 3-year rolling return period, the portfolio has outperformed its underlying benchmark. Barring this period 2017 to 2020 is where the fund underperformed, and this is also on the backdrop of the recovery in the markets. What we have seen in 2020 after the COVID correction, our participation has been relatively lower, and that has impacted the quantum of outperformance. But clearly, over a 10-11-year time frame, any 3-year rolling return period, the fund has outperformed its underlying benchmark. But for all our investors who have come in this period of 2016, 2017, obviously are still witnessing underperformance. Some of our older investors also would have seen their outperformances trimmed down. But as I said, that with all the changes in the portfolio fundamentals looking absolutely very, very robust, we feel that this portfolio will benefit from both twin engines of growth. One would be the earnings growth, and one would be a lot of re-rating in the price earning multiple of a variety of stocks which are looking very, very cheap at this point of time. At this point of time, the portfolio fundamentals, which I will show you, clearly are demonstrating the valuations to be at its bottom. We are seeing a very sharp or dramatic recovery in the earnings growth, and the P multiples have still not caught up. So to that extent, the margin of safety in this portfolio is very, very high. Going forward, we feel that with these portfolio fundamentals, the downside will be limited and upside could be unlimited. This is another slide which all of you can use it at your own disposal to decide whenever you make allocations between mid caps and large caps. Now, very simply, what you need to do at the day end, divide the small cap 100 price divided by Nifty 50 price. You divide this, you will come with this number like today it is 0.63. At the bottom of 2020, it was 0.41. At the peak of 2018, it was 0.87. If you pull this chart for, let's say, 2000, right from 2000 till 2022, what we have seen is that every time this index goes to 0.87 to 0.9, the small cap is actually peaking out. And this is the time where you do not invest money. At the same time, you should probably take your profits off the table. Equally, when you are at the levels of 0.4 or closer to 0.4, these are the times when you switch your position from large caps into mid and small cap, because this is absolutely at the bottom. So from the bottom of 2020 0.4, we are already traveled the journey of 0.6. 3,600 small cap index is already at 10,800 or 11,000 odd levels. Correct? Now, the gap between the peak and the current index is about 30 basis point, right? So therefore, there is still a lot of gap between getting into the peak zone or the overbought zone. But at the same time, it is not as cheap as it was probably 2 years back. And so therefore, we feel that the room to make returns from the small cap continues. But from your overall allocation perspective, a balance between large and mid and small, a good balance of 50-50 will really help. But definitely a lot of upside is still left. The previous peak was 9,500 for small cap index. Today we are at 10,800. So the long-term returns, a 3-year return for the index itself has been very muted at 10-11%. So a lot of catch up yet to happen on 3-year basis. And as I said, that there is a positive correlation between the economic cycles and the returns from the mid and small cap. I feel that as the economic cycles will give you a 13-14% nominal growth, you will see that the mid and small caps will do well, will deliver higher growth and result into high price growth. So the case for investing or remain invested into mid and small is certainly out here for all of us to see.